Managers are preoccupied with cash flow to an even greater extent than with net profits. There are good reasons for this. If your working capital is not strong enough to pay current bills on time or to finance expansion when opportunities arise, then profits showing up on paper are useless. Cash is much more important than profits. When a combination of mitigating factors erodes working capital, the consequences are negative. Slow payment of current bills leads vendors to pursue collection, further eroding a company's credit. The company then finds it impossible to get financing. Meanwhile, current obligations for the repayment of principal and interest are absorbing a growing percentage of profits each month. The tendency is that once cash flow begins to deteriorate, it only gets worse. To calculate the dollar amount of cash flow each month, first begin with the reported net profit, then add in non-cash expenses and other sources of funds. Afterwards, deduct all payments not reflected in the income statement. Non-cash expenses include depreciation as the most important adjustment. If prepaid accounts and reserves have been set up, the current year's expense entries to those accounts should be added back in as well. Other sources of funds can include proceeds from new loans approved and granted, sales of capital assets, legal settlements received. Non-cash declines in cash flow include payments made for purchase of capital assets, repayment of loan principal, dividends declared and paid, legal settlements paid, payments to reduce current liabilities. And here is the formula for cash flow, which is a bit longer here, but in general it's the net income and then non-cash expenses, loan transactions, capital asset transactions, legal settlements and other adjustments are added, which are with positive sign, and also the same things are subtracted plus dividends paid if they have negative impact on cash flow. But let's see this on a spreadsheet where it's much easier to be understood. Okay, here is the example with some figures. Here is the net income, non-cash expenses, loan proceeds, sales of capital assets, receipts as legal settlements and judgments, and other adjustments increasing cash. Those 5 elements of cash flow, they are added to the net income because they add value. And these 5, loan repayments, purchase of capital assets, payments of legal judgments, dividend paid, and other adjustments decreasing cash, are subtracted. And here is the formula where you can see the net income and the sum of those 5 elements which are added to the net income, and afterwards the 5 elements that are subtracted at the end because they have negative sign. These are repayments, purchasing, payments, dividends, and other things that are added, that are sales, loan proceeds. Okay, and here is the formula, the end result for cash flow. Cash flow calculations certainly affect your ability to expand operations or to reduce debt levels, not to mention keeping current obligations current. These calculations should be included in the budgeting process, with expenses expressed in the form of the coming year's budget, revenues in the forecast, and cash flow in the projection. These variations in terminology help to clarify the distinctions between the groups of activity being estimated within the overall budgeting process.